Welcome back to The Open here on BNN Bloomberg, and thank you so much for being with us. We're back with Phillip Petursson for a second conversation. Phillip is Chief Investment Strategist at IG Wealth Management, and we are going to talk about some of the big risks he sees in the market in 2025. And one of them, and a lot of people are pointing to this, is steep equity market valuations in the U.S. You've said Canadian stocks are trading at what you see as attractive valuations. That's not necessarily the case in the U.S.
Exactly. The U.S. is trading at an elevated level in terms of price to earnings multiple, price to book, price to sales. Pretty much any valuation metric you want to apply to it, it's at higher levels. It's in the top decile over the last 20 years, and to us, that's a risk. And that risk doesn't necessarily dictate what's going to happen over the short term, but it can, and you need to be aware of it. So obviously, we could see a valuation correction. Mentioning earlier that we see the Federal Reserve not being as aggressive with rate cuts, the long end of the yield curve, the 10-year yield in the U.S. is probably staying around 4.5%, but could see 5%. That's going to weigh on valuations. That we really haven't seen a lot of pressure on valuations through 2024. But is that what we're seeing emerge in the marketplace over the last week or so? Maybe valuations coming to the forefront, and that could trigger a correction next year at some point.
So one of the big questions is, can earnings catch up to these valuations? Can earnings support these valuations? Now, I see the market calling for earnings growth of S&P 500 companies of 13.5%. Is that more or less the ballpark of what you see as the consensus?
Exactly. We see that, and when you look at some of the macro indicators that lead to an earnings growth assumption, we're in that ballpark. Now, what tends to happen when you see a strong earnings year, you don't get a 13% return. What you get is less than that. And that takes us to our mid-single digit expectation that if earnings do materialize to a 13% return, you're only going to maybe see half of that, maybe a third of that in market appreciation. So this, we have to go back to 1993 to 1995 for a scenario similar to what we have today. Very high valuation, a good earnings environment, but the market for 2 years pretty much went sideways.
Right. How good is 13.5%? That's a pretty high hurdle for the market to get over, isn't it?
It is.
Earnings-wise?
It is, and maybe we don't come in at that. Maybe we come in at 11 for the year. But the direction is improvement on the earnings side. This past year it was 7-8%. So momentum is in our favor. And we do see stronger earnings for 2025. But again, we shouldn't get too excited about it because typically when you do see a strong earnings year in that 10 to 20% range, you get a PE multiple contraction of 2 to 3 points.
We talked about the Canadian economy in our first conversation. One topic we didn't touch on is the tariff threat from Donald Trump, which quite conceivably is only about 20 days away now.
Exactly, and that's not just for Canada, that's for the world if you listen to it. And that's one of the unknowns. Is it just a threat? And I think our view has been that this may be more of a threat and a negotiating tactic than actual policy. It seems that he has some individuals around him saying this is not good for the U.S. I mean, as much as you believe it is a positive, it could do harm to the U.S. economy and the momentum that we're seeing. So, but it's something that you have to plan for. And so how you hedge against that is U.S. small caps. So while U.S. large caps are expensive, small caps on a relative basis are attractively valued. And they're less sensitive to global tariffs. And so they could actually be the winner in a tariff outcome.
We talked about currencies from the point of view of the Canadian dollar, where you see more weakness versus the U.S. dollar. Why don't we speak about the U.S. dollar, which, of course, is the dominant currency in the world and is always a factor in markets. And we have seen over the past couple of months a real surge in dollar strength.
Right. And it's a risk. It's a risk to the rest of the world that whether they trade in dollars or they manufacture in local currency but sell in dollars or operate using dollars, this is a challenge. And we've often seen this as the U.S. dollar strengthen. It's a headwind to emerging market bonds. It's a headwind to emerging market stocks. It could be a headwind to gold as well and other commodities. And so it is one of the other risks, the strengthening dollar. Will it continue to strengthen in 2025 versus the Canadian dollar? Yes. How you hedge that is own bonds, own U.S. dollar-denominated bonds that are already paying you a mid-single digit, that if you can pick up a couple percentage points on that, it'll protect you in terms of some of the volatility, equity volatility that could come from U.S. dollar strength, and also give you a little bit of a boost in terms of your fixed income return.
Phillip, thanks for everything.
Thank you.
Have a great 2025.
You as well.
Phillip Petursson.